The CPI inflation report came out for January 2023 and it was pretty bad, especially compared to the expectation. We had a positive streak in the past 3 months where market expectations about inflation were always beat, aka inflation was always better than what people expected. Inflation for January, which came out today, February 14th, is at 6.4%. It is better than what we saw last month, which was 6.5%. However, it is unlikely that at this pace we can get to the 2% target rate by the Federal Reserve soon. Some accounts, YouTube accounts, are talking about 2% being reached around 2023. Others talking even about 2027. Inflation is expected to continue to hover around 5% in the next couple of months, which means that inflation is sticky. And this is a problem because we're trying to get to a lower level. Month of the month, inflation increased by 0.5%. When I talk about inflation, I'm talking about the CPI, Consumer Price Index, which is higher than the expected 0.4% I mentioned in the beginning of this video. The CPI, on the other hand, on a year-over-year basis was a 6.4%, higher than the predicted 6.2%. Energy price and supply chain disruption had already been addressed to some extent, which helped out prices, but we have not reached the efficiencies we had pre-pandemic. We still have a lot of businesses that are having supply chain problems, some who have been disrupted, almost destroyed, and we'll go over it very soon. The core inflation rate has increased to 5.6%. Core inflation is everything minus energy and some other factors. And take a closer look at the year-over-year statistics, energy prices have risen 8.7%. This is why core inflation is lower than the actual inflation. Services excluding housing are up 8%, shelter is up 7.9%. Food, on the other hand, is up 10%, mostly driven by stuff like eggs that we saw in the past couple of months. It is interesting to see Jerome Powell celebrate about inflation or be very optimistic about inflation when food is the major driver of inflation in this month's report, mostly driven by eggs, which are up 70% year over year, which is very bad. Sounds very bad, but it is better compared to the 500% we saw last month, mostly driven by the flu, the chicken flu, that was killing millions of chickens and taking away a lot of supply of eggs. Moving to energy, electricity prices are up 11.9%. Utility gas up around 27%, a little less than that. Gasoline prices will likely increase even more now that China has fully opened after the pandemic. And as they start to consume more and more, they will create some supply chain issues. We have been literally living without the demand from China for the past couple of years. And China might drive the prices back up unless something is done on the supply side. The shelter index has risen 7.9%, accelerating from 7.5% in December, while services excluding housing have gone up by 8%. The labor market is also a significant category of concern for the Federal Reserve. They fear that the labor market is overheating too much and the supply-demand imbalance for workers may result in wage inflation, which was one of the drivers of inflation in 2022. Going back to shelter, as you may know, if you follow me, I do real estate. 2022 was supposed to be the year in which real estate would have been crashing like it happened in 2008, if you look at all articles across all media outlets. I did real estate. I actually went full-time into real estate and I experienced one of the best years of my life. Now, I specifically do entry-level housing, so I'm not affected as luxury homes are affected. In my case, on houses that I did not touch, I perceived a 10 to 20% increase in equity. In my, let's say, flipping business, I did better than average. I achieved a 100+% return on investment on my flips throughout the whole year. So, supposed to be a very bad market, actually went extremely well. The question is, will this pace continue? Will it slow down? Or will it decrease as some are still expecting? In January, the job gains were remarkable, exceeding expectations by 8 standard deviations, which is quite impressive. In January, the job gains were remarkable, exceeding expectations once again. The Federal Reserve has been expecting unemployment to rise, but we're still at historical low levels. Let's shift to focus on inflation expectations, which are critical to understanding consumer behavior as it impacts inflation rates. Based on macroeconomic data from the Federal Reserve Bank of New York, people's short-term inflation expectations still indicate a rise in prices. People are expecting prices to go up as they have been going up until now. They are expecting an inflation, but at a slower rate. They started to see that prices are not increasing on a weekly basis as it was during 2022. In contrast, the long-term outlook is more pessimistic, indicating that inflation will be an ongoing issue. This differs significantly from the pre-pandemic era, where inflation was not zero, but relatively low. There were changes, but they weren't really felt by the people. Regarding the labor markets, about 41% of respondents believe that unemployment will be higher than the next 12 months, which is a slight increase from December. There's some pessimism on the market. When it comes to household finances, the latest report suggests that spending growth will slow down in 2023. Median household spending growth expectations fell from 6.9% to 5.9% in December, and then to 5.7% in January. This is the increase in spending expected for 2023. This trend of declining expectations was consistent across all groups of ages and incomes. Americans are increasingly relying on credit, and savings are shrinking by a lot. We saw this in the past couple of months, but now from lower savings, now we're getting into more debt. People are trying to keep up with their lifestyle they got used to in the past couple of years, and they cannot do it at the current prices. The trend is driven by two things. What the media say is the wage growth being outpaced by the increase of prices, meaning wages are going up, but not at the same pace as prices of food, consumer goods, and everything. And secondly, I believe as a consequence of the lifestyle we saw during COVID. During COVID, people did not travel as much. They stayed at home more. They had more, say, money that they could consume with other things. And once normality kicked in, as well as the costs of normality, for example, commuting and everything, people did not expect that return to normality to include so many costs. So now you have a new lifestyle plus these other costs that drive your cost of living even higher. Now, this is more of my opinion. The first side is more backed by data. And as a consequence, according to some surveys out there, like for example Gallup, 50% of respondents to surveys are saying that their financial condition is worse this year compared to last year. According to the Fed's Bank of Philadelphia and many other leaders in other fields, the outlook of 2023 is optimistic. The consensus is that there will be no recession in 2023. We projected GDP growth in positive numbers, not negatives. So the concept of a soft landing, of a continuous growth, even through these harder times, is there among most of the leaders out there in America. The predicted real GDP growth for the entirety of 2023 is 1.3%. The unemployment rate is predicted to increase to 4.1%, which, although is higher than the current level, it is lower compared to the expectations we saw last year. The expectations last year were that 2023 would lead to an unemployment rate of 4.4%. So we're 0.3% lower than that. The January jobs report showed better than expected job growth, while inflation is on a downward trend. The trajectory of disinflation and its effect on GDP and unemployment will determine whether a soft landing is achievable. It is important to pay attention to monthly reports on CPI, unemployment, and quarterly GDP statistics to keep track of economic progress. We have another inflation report coming in towards the end of this month. We're gonna see the Fed talk next month. General outlook seems positive about the economy. However, inflation is not going down as quickly as expected. It's starting to be very sticky. What does this mean for you? Well, if you can, not financial advice, but if you can, focus on saving. If you can, and this is what you hear all around everywhere, dollar cost average if you want to invest. There are some good opportunities already. There are some companies that still might have to drop a little bit more. In terms of real estate, and here I'm talking as a real estate investor and a realtor, do your research, don't look only at the media. We are currently in a situation where shelter, as I just said, has been still increasing. But why? Mostly driven by low supply. The areas where I invest in real estate have a supply that is lower by 30 to 40% compared to when I started real estate in 2022. which is the complete opposite of what media news were predicting last year if you read news and everything. Guys, if you would like to get more updates like this one here, please hit the follow button. I will try to make more. Take some time. Thank you for watching. Ciao.